When we invest in stocks, when we invest in shares, the potential outcome can be quite binary. We either will make money if we are correct, or we'll lose money if we are wrong. By using options, we can make our life a little bit more interesting. So in this video, we're going to be talking about the ratio spread. Now, the ratio spread is a very versatile and useful strategy. We can deploy it in a large variety of situations. For the purpose of this video, we're just going to be talking about one application of a ratio spread. Alright, the ratio spread is a variation of the debit vertical spread, which we talked about in an earlier video. For a quick recap, a debit vertical spread is a strategy that's made up of two option contracts where we buy one option contract close to the current market price and we sell a second option contract that is out of the money and further away from the current market price. The structure of the ratio spread operates on the same principle, except that we're going to be selling more options compared to the options that we buy. As an example, if we're looking at a 1-to-2 ratio call spread, this means that we are selling two further out of the money options for every one call option that we buy. Another example, maybe a 2-to-3 ratio put spread. This means that we are selling three further out of the money put options for every two put options that we buy. Let's explore this further using an example. Please remember that this example is for illustrative purposes only. It's not meant to be taken as investment advice to buy or sell any particular security. So first up, we see that this stock has made a move to the downside. Let's say I'm long-term bullish on this particular stock and I want to buy this particular stock. But I like a good deal, I like a good bargain, so maybe I've identified $320 as the price that I want to buy 100 shares of this stock. For this example, let's say I want to execute a 1:2 put ratio spread. So I will buy one put option, maybe with the strike price of $335 with 2 months to expiration. To buy this contract, that will cost me $1,000. At the same time, I'm going to be selling two put options that are further out of the money, maybe at a strike price of $320, also 2 months to expiration. Each of these contracts are worth $600, so for selling two of them, I will collect a premium of $1,200. So all in all, for executing this strategy, I will actually collect a premium of $200. Let's explore this payoff diagram to see what are the potential outcomes on expiration day. On expiration day, if the stock price is above $335, all of these options will expire out of the money, therefore I simply make the $200 credit that I received. If the stock price falls below $335, then the put option which I bought is going to start to increase in value. So actually I will make more money as the stock price falls, and the maximum return that I can make is $1,700 if the stock price is just above $320 by expiration date. And that's because the two put options that I sold will expire out of the money on expiration date. As the stock price continues to drop further, I'm actually still making money on the put option that I bought. But the two put options that I sold are losing money twice as fast. So at some point, I'm going to reach a break-even point. And that break-even point is at $303. If the stock price continues to fall beyond $303, that's when I start to lose money on this position. The maximum loss is if the share price falls to zero on the expiration date. So this is the range of potential outcomes of my trade. What do we see here? First of all, to state the obvious, as long as the share price is above $303 by expiration date, I will make money on this trade. In fact, even though I'm bullish on this particular stock, I'll make the maximum gain if the share price were to fall in the opposite direction, as long as it doesn't fall by too much. What happens if the share price falls below $320 by expiration date? Remember, this is a 1-to-2 ratio put spread, which means I bought one put option that is closer to the current market price, and I sold two put options that are further away from the current market price. Now, if we break this strategy into two parts, we will see that actually it's made up of one debit put vertical spread and one short put option. Since this is already a share that I intended to buy at $320, I will simply allow the short put to be assigned and I will be obligated to buy 100 shares at $320. And at the same time, I will close the debit put spread at the maximum profit of $1,700. So this was just one example of the many ways that we can use ratio spreads. The main idea today is that when we trade or when we invest using options, our profit and loss outcome doesn't need to be binary. We see here in this example how we have set up this trade using 3 option contracts to ensure we have a 90% chance of making money regardless of how the stock price moves. So ratio spreads is just one of many option strategies that we can use to customize the various outcomes, the various ways we can make money from the market based on how we think the stock prices might move. As we go along, I'll provide more real-life examples of ratio spreads that I execute so we can study the various ways in which we can customize and use this strategy. Make sure you're subscribed and stay tuned for that. So that's it for today's video. Like, comment, subscribe if you found it to be helpful, and I will see you in the next video.